I didn't know everything, right? And connecting with other people who could teach me, I could learn from, and then maybe I could share some stuff with them. I was just super helpful and active. But for me, it's even more important when you decide to be a passive investor, because everything's out of your control, right? You need to learn and educate yourself. Almost every investor that I talk to says that it's invested in their first couple deals before they find a community. Almost every single one of them say, I wouldn't have done that first or second or third deal, right? I would have done something different. You know, Whitney, you might have the best deal ever, but if you have that, your next one's going to be pretty good too.
This is your Real Estate Syndication Show. I'm your host, Whitney Sewell. Well, today we have a returning guest, Jim Pfeifer, and he's one of the founders of Left Field Investors. You've heard him on here before, where we have talked about a number of things, topics around passive investing. But today he's representing Passive Pocket. It's a transition that Left Field Investors is going through. You're going to hear him talk about that briefly. However, we're going to talk mostly about the things to help passive investors and things that I wish I had known years ago when I started investing passively, things Jim wishes he had known, but the importance of community, even how to spread out, say, an amount that you have set aside to invest passively, how many different investments, how many asset classes, how many different operators, markets. We're going to go through a number of those things. Should you use a disregarded entity? That's a question I get all the time. As far as how to vet an operator, we talk about that a little bit, but also investor updates or property updates. What should those look like, and what should the expectation be there, around that. And so, if you're a passive investor, you're thinking about investing for the first time or even the 10th time, you're going to learn a lot today, just through the discussion that Jim and I have around passive investing. Jim, welcome back to the show. I'm looking forward to the conversation. I know you have recently had some big changes with the just amazing community of passive investors that you built at Left Field Investors. And I know you're going to give us an update there, because I want our investors that are listening to, is to hear the importance of community, right? And maybe we'll talk through some examples there, but then also hopefully we'll get into some things newer investors and maybe even seasoned investors need to know, just from things you've learned from an amazing community of investors as well. So welcome back.
I'm super glad to be here, and just hope we'll have a great conversation.
No doubt about it. Jim, let's start right there, because I know after you've built a community of investors, over a number of years, speak to the importance of community, right? For one, and maybe let's dive into a couple examples of maybe an investor that that's, hey, we was going to make this investment, but you know what? After seeking a community or other investors, right, made a better decision, or maybe to invest, or one way or the other.
We didn't start Left Field Investors, now Passive Pockets. We didn't start it on purpose. It was really a selfish thing. We were just going to do a little mastermind, because what I realized as an active investor is I didn't know everything, right? And connecting with other people who could teach me, I could learn from, and then maybe I could share some stuff with them. I was just super helpful and active. But to me, it's even more important when you decide to be a passive investor, because everything's out of your control, right? These investments are long-term and they're illiquid, completely illiquid. And as the investor, as the limited partner investor, I have no control, right? It's all in the hands of the GP. If I bought a single family home and things were going poorly, I could sell it, right? At any time under my own choice. And maybe I'd lose money on it and all of that, but at least I have a choice. With the syndications, you really don't. And so the only way you can test out an operator really is to invest with them. And then you're not going to find out whether it went well for 3, 5, 7 years, right? So if you want to be an investor this way, you can't make one investment, wait 7 years, and then decide, okay, now I'm going to go again. How do you figure that out? How do you figure out who the good operators are? And one of the best ways I've found is by relying on people that you know, like, and trust, who are a part of your community, right? You develop a relationship with them. Now, let's say they've invested with an operator and they've been there, for a year or 18 months or something. They won't know if it's going to go perfect, right? You never will until it's over. But they will at least know that, hey, I sent my wire and it was received. That's a big relief, right? And then, the operator sent reports like they said they would. They, sent distributions like they said they would. Or they didn't, and they communicated it effectively. You're still going to do the same due diligence on that operator, but you're going to start from way ahead, because you will have already known somebody that you know, like, and trust, who doesn't have an agenda, right? They're not they're not getting paid for this referral. They're just somebody that you know and is in your community. And they're saying, hey, I invested with this person, and so far it's going well. And that is just a huge step forward. Now, there's a whole lot of other benefits to the community as well, but that's kind of number one for me. And then we have plenty of examples where someone will come on to in our community, and we have a forum where you can post things and have interactions with people, and they'll say, hey, has anybody ever heard of ABC Operator? A couple of people say, yep, I invested with them. They're fantastic. Here's what's happened. Here's what I think about them. Here's some of their strengths, and maybe, well, here's some things I wish were better. And you just have a dialogue, right? And then other times you post the same thing and someone says, whoa, you know what? I had a bad experience with them. And here's what happened. Here's why I wouldn't invest with them. And it's always going to be your own choice, right? If just because one person had a bad experience doesn't mean that's a bad operator, but you can get different opinions, right? You'll get someone who says, I didn't like them, I wouldn't do it again. You'll get someone else that, hey, I had a great experience. So the purpose of the community really is to lift all boats. It's to help everybody. And, as much as I've been doing this for a long time and I'm able to help people now because I have some experience, I think the person that's gotten the most out of the community is me, because I've learned from everybody. And you can learn from someone who's making their 100th investment just as much as you can learn from someone who's about to make their first, because they ask the questions you might not have thought of. So I think community is the number one thing, the number one factor in becoming a successful limited partner investor. That's my opinion.
Yeah, no doubt. There's so much benefit in community. I feel like in so many aspects of life, right? And it applies to investing your hard-earned cash, your hard-earned money in the same way. One thing you mentioned was this, giving up control. One kind of investor where they want to give up control to somebody who they feel is more knowledgeable or more experienced, right? There's one reason they're investing passively, and in another way, some investors don't want to give, they kind of, cringe a little bit at the fact they're giving up control. But it's why you're doing like what you're doing, right? You're getting some different opinions and people that have been there, with this operator and those things. So you feel good about giving up that control, right? Because of their experience. But how do you maybe personally manage that balance or give advice to somebody who might be struggling with that? Hey, I don't want to invest in syndications because I don't want to give up control. I'm just not going to do it.
Right. And it's huge, right? That's one of the biggest components. But let's back up and look at what are the other options, right? Let's say you're a stock market investor. You have zero control. In fact, if I invest with you, Whitney, I can call you up and say, hey, what's happening on this project? And I get to talk to you. If I invest in Apple, I could call Tim Cook, but he's not going to talk to me and take my call. I mean, that's ridiculous. So, you got to compare it to something. But then if you really want control, then you really have to be an active investor, right, in real estate. And for me, I did that. And I was successful because the market made me successful. I happened to pick a great time to invest and everything went up. But I was a terrible asset manager, right? I didn't enjoy it and I didn't do it very well. Nothing cash flowed like it was supposed to. I made all my money on the exits. So for me, giving up that control was a good thing because now I can hire a professional asset manager like you, Whitney, who knows what they're doing. This is your job. This is what you do every day. You're not just doing it on the side like I was. So, as long as you pick the right partners, then you can become comfortable giving up that control. Now, if I had a skill like I, bang a hammer better than the next guy, or I had some very specific market knowledge of a certain niche in Columbus, Ohio, where I live, then I have advantages over people like you who do this for a living. Then maybe I would have done something differently. But for me, giving up control, yeah, I don't like it, but I'm giving up control to someone who I've talked to, someone who have a relationship with, someone who, I at least feel good about. It's not a person that I don't know somewhere, it's a lot different. That's why this kind of investing is so personal. I think it's not like, if you go invest in a REIT or something like that, where it's very impersonal. Yeah, sure. You can make money that way. You're giving up all of the control. Now this way I am giving up 99% of the control, but I still can influence and have conversations with the person who is in control. So yes, if you're the kind of person who just does not want to give away control at all, this is not the way to invest. But if you can get comfortable with it, then this is a good way to go.
Great answer. I give a similar answer all the time as well. I'm like, well, how much control do you have over that Apple stock that you bought, or, no matter how many iPhones or iDevices that you and your family buy, it's not going to affect that stock.
No, not at all.
But it's a great answer. I agree completely. You can talk to the operator. I hope you can anyway. or get pretty close to boots on the ground who you're talking to, right? And even in our case, I love for investors to even talk to our guys on the ground or whoever's the asset manager, right? I mean, directly if they want to, or obviously talk to me. That is a great way to just share information and even, like you said, have some influence. So, hey, there may be an investor who's had experience in a different deal, and they're like, "Hey, Whitney, I invested in another deal that's similar to this, and this is what that operator did." I'm like, "Well, I mean, that's a good idea. I'll think about that, right?" Or so there are ways to influence the potential outcome of a deal, even as an LP. But like you said, you are giving up the control for a reason, right? Unless there's something, like you said, you got some very specific knowledge in a market that you can go take advantage of. But that's not typical, I would think. What about the being illiquid? Like I hear that often as well. It's a problem, and we've had investors. There's been different things come up where life happens. Somebody passes, or child's going to go to college, they're going to need more money than they expected, or whatever it may be. And hey, I'm sorry, Whitney, but we really need that investment money back if possible, right? Well, that's hard to do.
It is.
And we try to work that out. We'll try to reach out to other investors and see if they want to buy those shares, something like that, for one reason or another. If an investor is in a hard place, and that's happened some recently, where people are in hard places and need some cash, and but I never guarantee that, because I can't guarantee they're going to have it. However, how do you maybe plan for that, Jim, or advise, say, investors to plan for, that type of investment, knowing, hey, it's not available to get back next month?
I love that question because it's one of the big errors I made when I first started this. I was just so excited, and I knew this was what I wanted to do. This is how I wanted to invest. So I kind of went all in. And at the time, this was, a few years ago, when a lot of deals were going full cycle in 18 months, 2 years, 3 years. So then I would just re-up. I had too much of my capital tied into these types of investments. So when the market changed, and now deals aren't going 3 years, right? It's 5 years, 6 years. Now they're being extended maybe 7, 8 years. Now I'm not very liquid. So it is a great question. It's something you really need to think about, that you really can't commit any cash that you think you might need within the next 5 to 10 years, right? It's got to be cash that you don't need. Now, that doesn't mean the cash isn't going to be working with you. Sometimes because you don't have it, it protects you, right? Because you're not going to invest in something else just willy-nilly. But you really have to figure that out. And so I kind of went on a journey where I'm a former financial advisor. I had everything in the stock market. And when I found real estate, I was like, there is no purpose for the stock market. Never again. I'm not playing that game. I went all in, and I got a little bit too illiquid, as you mentioned. So then I realized, you know what? There is a place for the stock market. You need to keep cash. And one of the things that people are constantly talking about on the Passive Pockets forum, we're constantly getting great posts on this, is where do you keep your short-term cash, right? And I keep it in several places. I keep some of it now in the market because I want to have a chance at a return and have it liquid. I keep some of it in a whole life cash value life insurance policy because that's a great place to earn a return, and then I can use that cash to invest. And then I now, especially with interest rates higher than they were over the past few years, you can keep some of it in a money market or a T-bill or wherever you want, but you got to keep some cash and for emergencies and opportunities, so you don't get into that situation. And, some operators like you will work pretty hard to try to find a match and allow you to get out of your shares. Some aren't even going to have the discussion. So again, if you think you're going to need that money, then it's not appropriate to put it in a syndication investment. You just have to really think those through and have a strategy for, okay, I have some excess cash. I'm not going to need it. Let's put it in an investment of this type.
Yeah, keyword excess. I've had other people that want to invest with us, and I already know they've been a friend for a long time. Already know a little bit about their financial situation potentially. I might even say, hey, is this all the cash you have? Like I don't want you to do that, right? Or I want you to use a fourth of that. Get your feet wet, but I don't want you to be in a hard spot a few months from now.
And it's hard because people get so excited once they find out that this is possible. Like you can make money, you can do really well, you can become financially free doing this. So like me, you want to go all in, but there's a couple of reasons not to. One is the liquidity, but also if you have, I don't know, $500,000 of excess cash that you want to invest, the temptation is to go find 5 or 10 deals and just do it all at once, right? But if you space it out, you'll be much happier in the end because you'll be able to see how some of the asset classes perform, how some of the operators perform, and just space it out because, what tends to happen is you get really excited about one operator because you meet them, you talk to them, and they're awesome. And then, you invest in one of their deals and they're like, hey, I got another deal with some open space and you went in on that one. I got another one. And so then you end up with no diversification because you're all in with one operator, which could turn out good, but often, it's best to diversify. So that's another thing to think about.
You mentioned, that getting excited. You got that. Okay, I've set aside this 500,000 here that I'm going to invest. Like you said, well, maybe I get excited and put it all really quickly in with one operator, or maybe even with two, but really fast. How would you advise? Let's and for I think for this example, let's just say we inherited $500,000. It's not like I expect another 500,000 next year or another 500,000 after that. But mom and daddy just left me this $500,000 and or whatever. I just sold something and made $500,000. It's not expected to happen again next year. How long would you say spread that out? Maybe some this year, some next year. What would you advise, Jim?
Yeah, I think I would go with that amount. I would say I would want at least 5 and maybe 10 different investments. And I would look to diversify, right? So I want to diversify by asset class, meaning I don't want to go all in on multifamily. I want something, some other asset classes as well. I would probably do at least 3 or 4 different operators. I would pick 4 or 5 different markets, right? So now I'm diversifying by a lot of different things that you could also diversify by debt and equity, by strategy. So there's a lot of ways to diversify, but I would probably try to stretch that out over a year. Right now, you mentioned it. This is an inheritance I got, so I have 500 grand. So there's no rush, right? You can do it over a year. Now, if it's 500 grand that I know I'm going to get every year because I'm earning a lot of money or whatever, but it's recurring, then yes, I would accelerate that a little bit. But I would also, the first year I would go slower than the second. You need to learn and educate yourself, and you'd be surprised. You think you know all you need to know, and then you're a year down the road and you're like, oh man, I wouldn't have done that one. Almost every investor that I talk to says that is invested in their first couple deals before they find a community. Almost every single one of them say, I wouldn't have done that first or second or third deal, right? I would have done something different. So it's hard, right? You got to be patient. Once you start giving your email address to operators, you're going to start getting deals. Whitney, you might have the best deal ever, but if you have that, your next one's going to be pretty good too. So I learned this from an operator, and he talks about FOMO, but it's really JOMO is the thing that he stresses, the joy of missing out, right? The joy of passing up on an opportunity and knowing there's another one. Just to MC Laubscher is the guy. I'm sure you've heard of him.
Oh, yeah.
But he came up with the JOMO, a joy of missing out. Because I always have like, I don't want to miss this deal. It's the best one ever. The joy of passing up on it, knowing that there's another one coming, is something too. So I kind of put that in the back of my head because I do chase the shiny object, a new asset class. I'm like, ooh, let's go get it. But you know what? There's a reason why some of these tried and true asset classes and tried and true operators are still around, right? Because they've been successful.
I've not heard that term. I do know him, but I have not heard that yet. That's awesome. Joy of missing out. Often some of your best deals are the ones you didn't do, right? And looking back, over the last 18 months, man, we've almost done nothing. I feel like compared to what we were doing, and in the heat of it, and it can be really frustrating or discouraging, right? But now, I think, phew. I'm so thankful, right? So thankful. It is joyful knowing that, hey, the Lord protected us from so many deals that we could have done that I'm so thankful we didn't do. But, you also mentioned a minute ago, you said, you're not going to know really how well the deal has done for, say, 3, 5, 7 years, potentially. Oftentimes, though, what I find, Jim, I wonder about your thoughts just from your experience working in a community of investors. Oftentimes, the deal fluctuates a little, right? Depending on the type of asset, that you're doing. Let's say it's a heavy value add. Cash flow may fluctuate a little bit. While I find in the beginning, investors love seeing those big IRR numbers, right? Whatever it may be, 18, 20, 25. But what I find is, oftentimes in let's say a heavy value add type deal, the cash flow is not always high, right? You're evicting a number of people, you're working through this business plan. And so when the cash flow drops, or maybe it's not there for a few months, they get really concerned, right? They get really worried. What I find, or what I feel, and I would love your opinion, is I feel like investors would rather see a 14, 15% IRR, but just know that it's going to be steady. Like I can just count on this, most likely, right? Anything can still happen, but still, it's just oftentimes it's just more dependable. Maybe it's a newer asset. The business is already operating. We're not having to go in and vacate half the property or anything crazy. But just wondered your thoughts as an investor looking at a deal. Is that something you say, okay, no, I would rather see a little lower IRR, but just know that it's going to be more steady. It's already operating business versus no, we're going to have to go in and kick doors down and kick people out, and the it's going to make the distribution fluctuate. But there may be a bigger reward at the end.
Yeah, this is all about matching the strategy of the asset you're buying to your goals, right, and your needs. And again, every one of these, oops, I made that mistake. So when I first got into this, I was going full time as a passive investor, but I was investing in some of these development or heavy value add deals, right? But I needed cash flow because I didn't have a W-2 and I still have to go get groceries, right? So I wasn't matching my needs with the strategies I was investing for. So the first thing I would say is if you need cash flow, make sure you're investing in one of those probably lower IRR deals that's going to give you cash flow fairly soon and fairly regular, right? That's a different investment strategy than doing a heavy value add, where if you don't need the cash flow, then yeah, you can take a little bit more risk, which is also going to probably less cash flow in the beginning for higher later. But so you have to match your strategy with what the investment is. But the other thing I would say is the distributions, you said it, are from cash flow. Cash flow comes from a business that's operating efficiently and is having a good month or a good year. It should not be the same every month, right? Because technically, if there isn't cash flow, if the business isn't operating, you want the operator to say, hey, you know what? Interest rates just spiked. Insurance costs went up, whatever. We're not paying distributions this month or for the next 6 months because we're going to protect your investment. Where too many operators think, no, I have to pay the exact same amount every quarter or every month because otherwise investors will think something bad's happening. No, business is happening. Pay more when you make more, hold it back when you don't. And when things are starting to look bad because of outside factors or things aren't going to pro forma, then don't pay distributions just because you said you would. Instead, communicate, right? That's all I want. I understand no deal is going to go to pro forma, right? It's going to be above or below. The only thing I know about pro forma is it's wrong. So just be honest with me and tell me, yeah, hey, we're doing better, so we're giving you some more cash. Or, hey, this isn't going like we thought. Here's why. Here's what we're doing to fix it. We're going to pay you less cash or save reserves for a better time, but we're going to get it all in the end. It's all about communication for me. And so I think investors need to understand this. It's investors that are putting the pressure saying, hey, I want that 7% every month. You know what? I want what's available, right? What the business is providing. I don't want you to overstretch trying to pay distributions. So that's kind of how I look at it. It's two things: match your strategy, and then also understand as an investor that cash flow comes from the operations of the business.
Awesome. I just had a couple thoughts there, a couple more things. I know I get questions about from investors all the time. Even this morning, I had an investor asking me, I wanted to get your thoughts, and I'll be able to point him to this as well, just a discussion. And so I also wanted to ask you, Jim, about your thoughts around, hey, should I have a disregarded entity that I'm investing through? Should I invest through my personal name? Should I, how do you do that? How do you typically see other investors doing that, holding investments in their own name or not? Or, yeah, I personally do not invest in my own name. I do have a disregarded entity that I use for even investing as an LP in our own deals. I use another entity as well, but just wondered your thoughts.
I use a disregarded entity also, but mostly it was because I had one that was just sitting there from my previous days as an active investor. One of the most experienced LPs that I know that has been doing this for years and years invests through his own name. Because I guess my answer is I don't think it really matters, because the liability it's very, very unlikely the liability is going to reach you, right? So from the asset. But what you want to protect yourself against is if somebody sues you personally for something outside of this, for car accident or whatever. And so you do get some protection by putting it in an LLC, just like you would with any of your other assets. It also, for me, makes it easier to kind of have a separate bank account and have everything coming in and out of that one entity. So I do like that, but I don't think it's necessary. Like if you're just starting out and you only have, you're going to make a couple investments, just do it in your personal name. And then once you get down the road and you feel like, hey, you know what, I might be doing more of these, then I would talk to an estate attorney or an asset protection attorney, I guess, and say, look, I have these different assets. Some of them are these real estate syndications, some are other things. How should I protect myself? And if they say, hey, an LLC, put some of your stuff in an LLC, then you do it. That's kind of how I look at it. But I don't think it's necessary in this type of investing. Now, if you're going to do active real estate, whole different story.
No, that's awesome. And I agree. I don't think it's a must, or, you don't have to, but I agree with what you said. I like having the separate entities, separate bank accounts. It's just easier to manage, see what's happening there at a faster glance as well. But you could even have a separate bank account for this, even under your own name, right? That you're attaching. So, what about just the number of investments across? And we were using that $500,000 example earlier. You said 5 to 10 investments, and I know operator friends of mine who have invested passively in 100 plus investments. I feel like that's almost, that's a full-time job to manage that at that point. That is so much just K1s alone, like trying to get all of those in, and ensuring that you have them in, or you're getting paid for all that. How could you even keep up with that many, right? Without having somebody, almost a team, right? Or your own family office, to some degree. But what are your thoughts behind that? Like a way to manage all these investments and track what's happening?
That's a tough one. And we've had some people post in the forum at Passive Pockets recently, like somebody was planning on investing, I think $5 million over the next couple of years because they had a big exit on a company or something. And they were planning on, putting 500 grand into each deal. And, there are some benefits to that because you might get better terms and things like that. But, my thought was, slow down, because you're just new into this. And what you want to do is maybe do smaller investments until you test people out. And 5 years from now, maybe after you've had some full exits and things and you understand things a bit better, then maybe you can up your investment size. But, I'm one of those guys. I'm in over 100 LP positions because we also have a tribe vest that we work with, which allows you to do smaller investments. But the way I manage it is I use a company called Visor. And they have just a great platform, because before I was using Excel, and it was crazy trying to manage all this. But Visor makes it easy. I can put it all in one place, the distributions, I can link my bank accounts, and it just makes it so much easier. That said, it's not easy. So, for me, I wish the investments that I've made that did really good, I wish I'd put more in, and the ones that didn't so good, I wish I put less in. But for me, I think you have to look at it as a percentage of the amount that you're going to invest. If you're going to put in $5 million, then yeah, maybe doing $100,000 minimums makes more sense. But if you're going to do $1 million over the next few years, maybe you do $25,000 and $50,000. Yes, your accountant's going to hate you, and your tax return is going to be a little bit more expensive, and it takes some extra. But the thing is, I after the downturn that we just had, the number one lesson I got out of that is diversify in as many different ways as possible. And it's hard to diversify if you're investing $100,000 or $250,000 at a time. So I'm not investing larger amounts unless I am rock solid with that operator. I've been through some investments with them, and I'm confident that they're going to do what they say they're going to do. And it takes a while to get there. So yes, I have too many LP positions. Absolutely. And I'm going to work on making that fewer as my assets grow and as my wealth grows. But would I start out any differently? No, I wouldn't. I started out investing the minimum in every deal. And as you know, I think every once in a while I ask for less than the minimum, right? So, because that's my way of testing it out. So I don't think there's a good answer to that, but you do need a software that can help you manage these, because once you get past 5 LP positions, it gets crazy. In my experience, Visor has just been great for that for me.
I like how there's a strategy behind it. You mentioned like, hey, I'm going to invest the minimum for a number of years in a bunch of different deals, operators that you're going to vet, no doubt about it, do some due diligence, get to know the operator. But then, in 3-5 years, you've been able to see the performance of lots of operators. Well, maybe the next time you do more than that, right? Or you've had some exits even by then as well, so you can put more in somewhere else. So I love that there's some strategy behind even long term, thinking through. And by the time you're 10 years in, you probably know your top 10 operators. By that time, you're going to keep operating or investing with, right, larger amounts. So, one thing earlier I meant to follow up on, I wanted you, especially from your background as an advisor as well, now talking to so many investors and being such an experienced passive investor yourself, Jim. Is this emergency fund? What would you advise that investor to keep on hand?
Yeah.
Like what you're thinking about. Just like from a personal perspective, hey, we've got 2 kids at home, or 4 in our case, but it's like life happens, right? And so I just wondered your thoughts behind that.
Yeah, this goes right back to the liquidity thing, right? And part of it is I have different buckets where I keep my emergency fund. One I have a HELOC, a home equity line of credit. So that's not money I want to use because it's variable. And so right now would be a bad time to use it. But emergency money, I could use it for that. Same with, I mentioned before my whole life insurance, the cash value of that is also an emergency bucket because I can get that at a very low loan. Or if I do it right, I can take it out with no tax consequence. So those are two places that I keep cash. But, the way I look at it is it's going to be so different for every person because I don't have a W-2. So, if I can't work, nothing really changes for me other than I won't be investing, like if something happens. So you have to look at, if you have a W-2, maybe you want to keep 6 to 12 months of cash somewhere. Now, I just wouldn't tuck it in the bank. I would put it in low risk places, right? And not the emergency money I wouldn't put in the stock market. Again, you'd put it in a safe place. So I think it really depends on the individual, but I like to make sure that, I can access a year's worth of cash at any time. But I also don't want to have all that cash in a place where there's zero return on it. And that's why, I kind of move things around a lot, I guess.
Like that. So a year's worth of cash, but you're strategic even about where it's sitting, right? So it's not just sitting dormant or losing value.
Yeah, exactly. And that's why, I'm a huge proponent of cash value life insurance because you can put it in there and make 5% tax free, right? Forever. And there's other protections with that. But that's why, that's a really nice place. And also, I know I already said it, the HELOC is a really great place because it's sitting at zero and costs me nothing. And then if something really bad happens, I can take a big chunk out of that. Now I'm going to have to pay interest on it. So, I have to be careful with it. But that's a great place to put emergency cash, right? And then nowadays you can get a return on just money in the bank account. So you can have some there too. But I think you just got to spread it around to different places and just make sure that you have access to it if you need it.
You mentioned earlier too, like money market, T-bills. How does someone go about doing that?
Well, so what I've done, I just kind of got lazy on this because I had a bunch of other stuff going on. So I just found the highest money market that I could get on my brokerage account. But I know some people will invest in T-bills or other short-term government type products, and you could buy those online or through your brokerage. But I just do it the easy way through a money market. I think it's paying. I think what I got in was like 4.5%, which is sounds like a whole lot when for years it was at 0.25% or something.
All right, Jim. Well, we'll transition a little bit to a few final questions, but I know everybody's wondering what you think about what's going to happen, right? What do you think is going to happen just in the real estate market over the next 6, 12 months, and how are you preparing as a passive investor for those things?
It's impossible to know, but one thing, and I've had some discussions with other experienced investors, and some are on the opposite side of what I think, but I think it's actually going to be easier to vet operators moving forward because 3 years ago, every time you try to vet an operator, their experience was, yeah, I've been doing it for 3, 4, 5, 10 years. And, my returns are 20% IRRs because everyone was doing great. Right. But now people have been through some rough times. So now anybody who made it through, you can ask the questions. Before it was, hey, have you ever had a capital call? If the answer was yes, it was like, I'm not investing with you. Now, if the answer is yes, it's okay. Tell me why. Tell me how you communicated it. Tell me how you got through it. Tell me what happened. And that might make me think, oh, you know what? I'm fine with all of that, right? So you will be able to ask questions of people and get real answers of how they get through something in adverse conditions. So to me, that's going to make the vetting process a little bit easier. And because, interest rates are now kind of heading down, maybe there's going to be, I think, a more match of buyers and sellers. So maybe there'll be some actual transactions happening. And I think there's some opportunity to get in on some pretty solid deals with some pretty solid operators. And I'm just going to really be careful, ask all the questions. And really for me right now, it's making sure that you communicate effectively and that you own up the mistakes that you've made or difficulties you've had. Because if you got through this with no difficulties, it meant you probably didn't have any properties at the time. So that's a whole different discussion. And maybe that's good. I don't know. But I just think that it's going to be rocky. But I think if you're careful and analyze things, I think there's potential for pretty good opportunities over the next 6 to 12 months.
Great answer. I love the willingness to ask questions and figure out. It's not only were there turbulent times, but man, how did you navigate the ship? right? What did you tell the passengers? you know, while you were in rough waters, what did you tell them? And then, did you get to shore? How did you get to shore? If you didn't get to shore, what happened? Another thing I thought of, because is what you like to see in investor updates. Tell me about like frequency and what you like to see in these updates. We get questions or suggestions all the time. We have spent so much time, our team, like in trying to have a good update, and I still feel like we're like still trying to fix it or make it better all the time.
It's a challenge because you can't make everybody happy, right? I personally, I would like a written report, either monthly or quarterly, that has a summary up top, tells me what's happening, and it very clearly says what's happening with distributions, what's happening with the loan, the things that are topical right now. Are you still going to pay distributions? What's the cap rate on your loan, right? Those are things that in this time period. So I would do a brief summary, and then, the topical things. And then I would just say, like most people do, what how many move-ins, move-outs, and all the statistics. And then I would attach the financials. I'm not going to look at them every month or every quarter, but that's what I'm looking for. And I know a lot of people are going to videos now, which I think some people really like that. For me, it just seems like a hassle to go click on a video, and like I want to read it at my pace, and a video kind of doesn't do that. Again, it's impossible to appease everybody. So that's me. I would prefer just a written report. It doesn't have to be monthly. Quarterly is fine, with just the highlights, so I can see it in one page. And then if I want to dig deeper, I go through all the rest of the pages.
I'm afraid it's our fault that people are doing video updates now. I'm afraid we probably started that mess.
Well, I mean, it's nice. I've seen your video updates, but you also do written updates.
We do.
You know, the way I do it is I wait for the written ones and I don't watch the video ones. But I think the nice thing about how you do it is you're kind of appealing to two different types of people, right? I'm sure some people love watching the video and don't want to read it. So it's impossible to get it all right. But for me, if it's regular, it's consistent, and I know it's coming, and you are honest about the good and the bad, and that's it. That's enough for me.
Yeah, I appreciate that breakdown, Jim. And we do like a video one month. The next month you'll get the actual written or more detail, as well. We've been trying to we've sent out a form recently trying to get just more feedback from investors as we try to improve that. But it's difficult to, like you said, to please everybody as much as you try. But we want it to be helpful, right? We want it to be. It's the whole reason we do it, and we spend way too much time on it for it not to be right the best that we can make it. So. Yeah, and even quarterly, we've done monthly updates since we started, and then I'm coming to the belief that if we did quarterly, I think more people would read them.
You're probably right, because I think they almost need to match the distribution payouts, right? If you pay out monthly, people might expect to report monthly. Some people do a short report monthly and then a longer one quarterly. I just think it needs to be consistent and honest, and so everyone knows it. That's it, right? If you're not hiding, you're communicating. And the only thing LPs have is communication. You can communicate in two ways. You can communicate by paying me, or you can communicate by telling me how the asset is doing. And that's really the only, it's not control, because I don't have the control, but that's the only way I'm getting informed. You can ghost me and not send me anything for a year and then send me a bunch of cash. And you know what? I'm probably never going to invest with you again because the communication was terrible. I didn't get updates. But if you're regularly updating me, there's some that do it better than others, and it'd be great to have it standardized. But as long as it's regular, it's good enough.
I like that. Or you said if you're not communicating, or maybe I switched this around a little bit, but you said if you're not communicating, you're hiding.
Yeah,
so,
exactly.
Yeah, essentially. What about, Jim? What are the most important metrics that you track?
It depends on the asset class, but when I'm evaluating something, I like to look at the rents and make sure that the pro forma rents are realistic, right? If you say, hey, we're going to increase rents 10% in the first year, maybe you're that much under on this asset, but how you can't just push a button and they all go up 10%, right? On multifamily. On self-storage, maybe, but not on multifamily, because you have year leases. So I just kind of check a few things like that. Like, do you have reasonable rent increases? Does it match the market? I like to look at vacancy, because when I was an active real estate person, I didn't understand what vacancy was, and economic vacancy and all the different factors that go into it. But, now I want to see it realistic and make sure that it makes sense for the market, the asset class, and all of that. So I usually check that. I also check the taxes on the pro forma, because if you're just rolling over, last year's taxes into this year, a lot of counties, when the asset sells, it sells for more, and then you get a tax. They charge you more taxes. So I want to see that you have that in the pro forma. And if any of these things are off or missing, I just take it as a way to ask a question, right? Because when I vet an operator, I'm asking a bunch of questions. So when they send me a deal, I'm going to send you, and you've probably seen this from me, I'm going to send you an email with a bunch of questions, and you're going to answer them all, and it's going to be great. And then you know what? I'm going to send you another email with more questions, even if I don't have them, because I want to know, are you willing to, I might be high maintenance. Are you willing to deal with that? I want to make sure that you're willing. You're not just going to say, Jim, I answered all those in the webinar. Well, yeah, I know. I watched the webinar. If I got this far, I watched the webinar. I want to know, do you know your deal? So I'm testing you. And some operators, and I think this is what you did, I sent that second email. I remember this, and you called me up and said, hey, Jim, do you want to talk about this deal? And that was fantastic, right? Because you weren't like, pain in the butt, move on. You wanted to share it with me. And so I appreciated that, and that made a big impression on me. But that's the kind of thing I'm looking for. So I don't know if I've answered the question, but all through this, what I'm trying to do is, are you willing to communicate with me, and will you show me that you know your own deal?
I was going to ask you that right now, actually. I forgot that we actually did that, but no doubt, if somebody sends me a bunch of questions like that, I'm probably just going to call you and say, because it's easier just to talk about it. And then I can really hear what your concerns are, right? And hopefully answer your questions. So I appreciate that. What about some habits that you're disciplined about, Jim?
I exercise every day. That's the first thing I do. I get up and I go for a long walk, and I entertain myself with podcasts for fun, podcasts for work, podcasts for real estate. And I find that if I don't do that routine on every day, it just kind of sets me off in the wrong direction. So I've tried to be, I'm not super disciplined about all that kind of stuff, but that walk for the last probably 5 years, I could count on maybe one or two hands the days I didn't do it. So that's my main thing.
What's the number one thing that's contributed to your success?
I think it's just I'm a broken record, Whitney. It's community. This community that we've started, and just being willing to go and share your mistakes with others. It's amazing how much you get back, right? When you're willing to say, hey, you know what? I'm not perfect. I lost some money on that deal. And then people start sharing their mistakes. And then all of a sudden you're learning from others' mistakes. And now I don't have to make the same mistake as you did. So I think community and just being willing to share. I think that's also part of this for me is I give back through the community. And again, a broken record, I know. But when someone who's new to our passive pocket says, "Hey, can you get on the phone?" Yeah, of course I'll get on the phone. And whether you're a member or not, if you want help and to chat to someone who's done this for a little bit, yeah, I'll do that, absolutely. And so that's kind of how I give back. Is I'm super fortunate to have the capital to invest in these deals and have this nice life. And my passion is education. It always has been. I've been a teacher. I want to teach people that, you know what, you don't have to invest through the stock market and work a W-2 your whole life. There are other ways to do it. You actually can do this. You don't have to already be wealthy to attain wealth in real estate. You really can do it. And so my passion is sharing that message.
Jim, I'm grateful for your willingness to share the message and just be willing to take a phone call, right, from any listener. So I hope they'll do that. I hope they'll reach out to you. But where should they reach out to? How do they get to know more about Passive Pockets and who you are, Jim?
Yeah, go to passivepockets.com. You can get a 7-day free trial and jump into the community. You can direct message me there, or Jim Pfeifer at biggerpockets.com is my email. And, I'm, like I said, I am happy to respond to emails or direct messages through Passive Pockets, or set up a time to chat on a phone call. So love to chat.
That's a wrap. Thanks, Jim.